All right, so thank you everyone for coming to our Where to Stash Your Savings for Growth class. My name is JC Finley and I'm the engagement specialist here at Zing Credit Union. I do a lot of our financial education stuff, coaching classes, and also a lot of our community outreach. So you may see me at a Zing booth here or there when the weather's much warmer anyway. So first, I like to start with what is a credit union? So if you're not familiar with what a credit union is, we provide not-for-profit banking products, loans, and services. Credit unions are actually owned by their members, so they have a say in how the credit union is led and operated. Since every member is an owner, it's a democratic financial institution where members vote for the volunteer board of directors to have a say in how the credit union is run. The biggest difference between a bank and a credit union is credit unions are for people, not profit. So we are not-for-profit institutions. This is just a brief diagram of how credit unions work. So you deposit your money with us into a checking, savings, money market, you name it. And we use that dollar amount to make low interest loans to fellow members. The profit made from those loans is put back into the credit union and returned to you as a member by better rates on things like mortgages and auto loans and fewer fees. Our overall goal is to serve our members and serve our community. A little bit about Zing and who we are. Our mission is to educate, deliver, and achieve. We want to have a financially educated community so that everyone can be reaching their financial goals. As I mentioned, we are a not-for-profit financial institution, and we have been serving the Denver Metro since 1934. We were actually founded by 5 city and county employees who pooled together just $50 to create the credit union. This class is a part of our free financial education program that includes our live classes like today, recorded classes. This one is also being recorded, our free one-on-one financial coaching. So you can sit down with someone like myself or one of our other certified coaches to talk about building credit, building savings, creating a budget for the first time, saving for retirement, you name it. And then lastly, we do have e-learning classes. These are about 5 to 10-minute modules, and these are available in both English and Spanish on our website. This is just a brief snip of what that e-learning courses page looks like. You can see we've got a bunch of different playlists there. We also have our recorded classes available at any time. You can go on our website and it will take you to our YouTube channel. So if you ever miss a class or are interested in a different topic, you can access these 24/7. So it's a good idea. So I like to start this class with this slide of where to not stash all your savings. Number one, we'll just go through these quickly. Inside a pet's food bag, hidden in a couch, somewhere it might be tossed out, or with a scammer that's offering to double your money. Anytime you hear something that says double your money, free money, anything like that, that should be a huge red flag. You don't want to give anyone your money if they're saying things like that. It is a good idea to keep some cash in a safe place in your home in case of an emergency. However, it could be easily misplaced or stolen, so it's recommended to stash your savings elsewhere. Hopefully, an insured institution would be great. There's other options we'll talk about today as well. So I know I'm someone who used to keep a lot of cash on hand. I had some siblings that ended up finding it. So it is better to keep your savings not all in your home in case something were to happen. Hopefully nothing would, but just to be safe. A few things that Zing Credit Union can offer you. So number one is empowerment. So like I said, we really focus on having a financially educated community. So that's with our financial education classes, free financial coaching, and those e-courses in English and Spanish, since we don't have a Spanish presenter at this time. We also have several savings tools. So we have a traditional savings account, and we'll walk through more of these later. We also have CDs or a certificate of deposit. These can be a great savings tool if you're fine with locking your money away for a certain term and then earning more interest on it. At Zing, we have a mile-high APY account, kind of like a roundup savings for any time you use your debit card, money markets, and then IRAs, which are used for retirement savings. Lastly, we do have credit building products that offer savings opportunities. So we have something called a credit builder loan, where basically you make your on-time payment to Zing for 24 months. And at the end of the loan, that's when we give you that $500 or $1,000 back that you've saved up to over the course of the 24 months. So that's like building your credit and building your savings at the same time. We also have secured credit cards where you kind of put away that security deposit. So you build up the savings, put that away, and then you can transition that to an unsecured credit card later. And then CD secured loans, which are very similar to our credit builder. So your money is insured at a credit union or a bank. So credit unions are federally insured up to $250,000 per person, and retirement accounts are insured separately by the NCUA at $250,000. Same thing for banks. They are federally insured by the FDIC. Both of these are government organizations, just different ones for banks versus credit unions. So this is a benefit of having your money at a financial institution that is insured, because even if that credit union were to, catch on fire or close their doors, your money is still safe and accessible. It's not going to be gone like it was back in the Depression era. So the first thing we'll talk about today is just a general savings account. I'm sure most of us here are pretty familiar with these, so we'll go through this pretty quickly. But savings accounts are easily accessible or liquid in banking terms, meaning that you can move this money around very easily. You can deposit or withdraw money from savings as often as you'd like. There is no limit. I feel like several years ago, before the pandemic, there was that you can only transfer out of your savings like 5 or 6 times without getting a fee. That no longer exists. So you can transfer to or from your savings as much as you want to. Savings accounts are secured because they're insured. You can earn interest on savings accounts. To be completely honest, most of the time it's not going to be much. Sometimes it's 0.01, maybe 0.1 if you're lucky. So they can earn interest. Automated savings transfers are awesome. I utilize these when I get paid, every 2 weeks. Transfer money from my checking to my savings automatically so I don't have to think about it. Lastly, savings can be great for just short or long-term savings. Could be emergency savings, so it's easily accessible in case you need it, down payment for a home or apartment rental, or gifts for birthdays or holidays. Just really easy to access. And most days with online banking, you can label these savings accounts so you can have multiple accounts for your financial goals. So some pros and cons of savings: very liquid and easily accessible. You can have your paycheck direct deposited and automatically transferred to this account. It can earn interest, probably not a whole lot. You can have savings accounts for your goals, as I mentioned, so have different accounts for different goals you have, and then joint accounts if you have a partner or maybe a business partner you're working with for shared goals. Some cons: they are lower interest accounts than other savings products, and there's typically a minimum to open. At Zing, it's only $5 to open a savings, but other places may have higher requirements there. Interest rates can change at any time. So if they have you at 0.1, they can change that to 0.01 whenever they want to. And there may be a monthly fee. I apologize here. This still says Denver Community. For those who don't know, we were previously known as Denver Community and switched to Zing in April of last year. So I apologize that is not updated here on this slide. But as I mentioned, we just have our $5 minimum balance for savings and no monthly user fees there. Now jumping to certificates of deposits, we often shorten this and call them CDs, not the kind that you used to play in your car way back when, but certificates of deposit. So certificates of deposit are a savings account with a fixed interest rate, so you're earning money, and a fixed date of withdrawal known as the maturity date. You are able to pick the term for your CD. At Zing, we have anywhere from 3 months to 60-month options, so pretty flexible and very customizable for what you're looking for. Typically, the longer of the term that you select, the higher the interest rate will be. So oftentimes, if you choose a 60-month certificate of deposit, you're going to be earning more money than on a 3 or 6-month CD. Once you open a CD, you are committing to keep the amount you selected, let's say $500, in the CD for the term that you choose. So basically, if you open a 12-month CD with $500, you're promising to keep this money locked in for 12 months. There are some special circumstances where you can add extra money to certain CDs. At Zing, we have a 6-month CD where you can add to it in increments of $25 or more. All of our other CDs, once you put that money in, it is locked in and you cannot add to it. Some CDs will even have different tiered rates within one term. At Zing, we don't have any like this right now, but it could be something to look out for at other financial institutions or possibly in the future. Pros and cons of CDs. So one of the biggest pros is much higher interest rate than what you're going to see on a general savings account. I'll have some examples of where our CD rates are sitting here in the next couple slides. You get to select the term as well. So if you want it only in there for 3 months or all the way up to 60 months, that is in your control to choose the term. It is a very low risk investment. So you are earning interest while that money is locked in. There's really not a lot of ways you're going to lose money on a CD. We will talk about early withdrawal penalties in a second. These are great for medium to long-term goals, especially if you can get an add-on CD where you can add to it. This could be a great opportunity to have your savings in a spot where it's earning some interest. And it does encourage staying committed to your savings since there are those early withdrawal penalties. It is not as liquid. So that means that it's harder to access these funds because they are locked in for a certain term. If you need to access your savings in the CD, you can request your funds and pay a penalty. Oftentimes, these early withdrawal penalties will only be on interest you've earned. Most times, you will never lose any of the money you actually put in yourself. I think there's a few circumstances where if you were to pull it out like right away, you may lose a couple cents off the dollar. But most of the time, these early withdrawal penalties are just going to be penalties on interest that you've earned, not the money that you put in. So like I said, very low risk investment. Oftentimes, CDs do require a higher minimum balance. So at Zing, we do require $100 to open up a CD. Oftentimes, that's just because we want you to be earning something when you open one of these. But these minimum balances can be as high as $2,500 at other financial institutions. So definitely worth looking at. Whoops. There we go. So laddering CD strategy. This can be a really useful strategy for, building savings, giving your money more, earning power over the course of several years or several months. So as I mentioned, it will give your money a higher earning power without tying them up in a single CD, all with the same term. So you can see on the right-hand side, we kind of have the image of a ladder here, each holding a CD with a different maturity rate. And then as you go up the ladder, the higher the interest rate you'll be receiving on that CD. As each CD matures, you can either cash it in or auto-renew. So at Zing, it auto-renews at the same term if you take no action. So let's say here you have a 6-month CD, it matures, you decide, hey, I'm not going to do anything with it here. That will just automatically renew into another 6-month term. If you decide, hey, I want this money back in my checking or savings so I can access it, you just let us know and we will move that money to your checking or savings or whatever account you have with us. So here's an example with the interest rates expressed as APYs. APY stands for annual percentage yield. And please note these rates are as of today, January 18th, 2023. I mainly just say that for the recording so we don't get in any trouble there. But basically, let's say you have $800 total to put into CDs that you don't need access to right now. This allows you to open a variety of CDs, one at 60-month, one at 36, 100 at 24, 200 at 12, and 300 in a 6-month CD. You can see here on the right-hand side, I included those APYs, or those interest rates, for the relative CDs. So this way, the longer you're keeping your money in there, the higher the interest you're earning, but it's not all tied up in that 60-month term. So next we have our roundup savings. So this is what I refer to as our mile high APY account at Zing. This is a great way to build savings automatically without thinking about it. And it gives you a reason to use your debit card. I know a lot of us nowadays, or myself, I use credit cards because I get cash back and rewards points. As long as you use them responsibly and pay them off every month, they can be a great tool. But this gives you perks using your debit card, because every debit card transaction rounds up to the next dollar and automatically transfers the difference into a separate savings account at the end of each day. We call ours that mile high APY because we have an interest rate of 5.28% for that roundup savings. As someone who uses this account, I will tell you that it can add up quickly if you are a frequent debit card user. So basically, here's a little example. Let's say you spend $5 or you spend $4.15 on a coffee. I could use a great coffee this morning. So basically, it will show a charge of $5 on your debit card. $4.15 goes to the coffee. The other 85 cents goes into that mile high APY savings account. So it just goes in there at the end of the day, and then it earns that 5.28% interest rate there. A little bit about the roundup savings. This isn't really an account that you can stash your savings in, but it's one that you can continually add to and have it grow over time. I've definitely seen some members that have gotten a good chunk of change in their roundup savings or their mile high APY account. Pros, it can have a great interest rate. That really depends on the institution. We keep it at 5.28 at Zing. I've had my account here for many, many years, and I've never seen that change. It helps you build savings automatically with every debit card, swipe, or chip purchase. And then it is liquid. So some people or some institutions will have these accounts locked in for a certain period of time or until you reach a certain dollar amount. But our mile high APY savings is liquid. So at any time you want to access those funds, you can just transfer them to your checking or savings. And the biggest con here is the only way that you can add or deposit into this roundup account is through your debit card transactions. So it does require you to use your debit card. Now, money markets. Money markets are a type of savings account that oftentimes earn a higher interest rate than just a regular savings. But the drawback here is they typically require a larger minimum balance to earn that interest rate. Money markets are very liquid, so you have unlimited withdrawals as long as you maintain that minimum balance. Automated bill payments and checks can be used from this account as well, which is awesome. And these money markets are insured at Zing Credit Union, even though they still are earning that higher interest rate than a general savings. A few pros and cons. Money markets do oftentimes have higher interest rates than savings, but they are typically still lower than CDs. CDs are able to offer that higher interest rate, that higher APY, because you're leaving the funds locked in for a certain term. The funds are liquid and it's a safe form of investment. If you have a large savings, you want it to earn a better interest rate than a general savings account, money market could be a great option for you. There are higher minimum balances. So that's one of the biggest drawbacks with money market. We have a minimum balance at Zing of $2,000. It could be up to $5,000 minimum balance depending on where you go. And there can be fees. So if you withdraw and then it goes below that minimum balance, you will be issued a fee for that. Account service fees if it drops below a minimum balance, and not all money markets are insured. So that could be a great question to ask if you're considering. It may not be insured at all financial institutions. Also, if you see that FIS right there, that stands for financial institutions. We just shortened that so it wasn't near as wordy on the slide there. At Zing, for example, our fee, if you go below the minimum balance, is $3. So every transaction you were to make under 2,000 or every withdrawal under 2,000 would be a $3 fee. So not a really expensive fee there, but not something you're going to want to incur a lot of. Now, jumping to retirement accounts, there's a lot of options out there. Some of them, are just at your regular financial institution. Other can be sponsored through your employer, like a 401k or 403b. So first, we'll talk about IRAs. IRAs stand for individual retirement accounts and are individually insured at some financial institutions up to $250,000. So as I mentioned, you have your normal account that'll be insured $250, and then the IRA is insured separately up to $250,000. If your IRA is a mutual fund or is in a mutual fund, that would be an account that's not insured. So some IRAs are in CDs or money markets. These are going to be your insured options. And some IRA CDs do allow add-ons. It probably just depends on that CD. So as I mentioned, mutual funds are not insured. This is basically a pool of money that is run by professional advisors. And then there's also something called index funds. Index funds have no active management. Basically, their goal is just to keep up with the stock market. And oftentimes with index funds, typically lower fees just because there's no one directly managing the account, with historically higher returns. So really just your option on what kind of IRA you'd want to look for there. Now, as I mentioned, you may have an employer-sponsored retirement. These are going to be 401ks or 403bs. These are employer-sponsored, so they're hosted by your employer. Matches will vary. It will really depend on if your company offers a match. It's really, really dependent on the employer. So I do have some numbers here. These are from 2020, so please note that these may have changed or increased in the last couple years. Maximum contribution limits in 2020 for 401ks and 403bs, sitting about $19,500 or up to $26,000 if you're 50 or older. Always keep in mind and look out for plan fees. These could be fees on just maintaining your account, if you have an individual financial advisor, anything like that. So traditional versus Roth IRAs, 401ks, and 403bs. So one thing to ask yourself, will you be in a higher tax bracket now in your career or possibly later? Maximum contribution limits in 2022, traditional IRA is at $6,000 or $7,000 if you're 50 or older. And then Roth IRA limits can vary depending on your income. There are early withdrawal penalties on retirement accounts before the age of 59 and a half. The amount added to gross taxable income plus 10% additional IRS penalty. So you really don't want to pull from your retirement before that 59 and a half. If you're able to, there are a few special circumstances. I believe we'll go through those on the next slide. So traditional IRAs, 401ks, and 403bs typically lowers your taxes paid on income during your contribution years. Your contributions are considered pre-tax income. Traditional contributions and earnings are not taxed until they're withdrawn. So basically, these are taken directly from your paycheck. And then when you take that money out after you hit 59 and a half or older, that's when they are taxed. There are some exceptions to early withdrawal tax penalties. So a couple to include here would be the first time home purchase. So if you've never bought a home before and you do take some money from your traditional IRA, 401k, or 403b, you will not receive any penalties there. A disability or death, qualified higher education expenses, and some qualified medical expenses. Although we typically don't recommend pulling from your retirement early, these are a few reasons that you might be able to without any penalties. And then at the age of 72, you will want to take out the minimum required to avoid any IRS penalties. So now looking at Roths, Roth IRA, 401k, 403b. So these ones are typically not a tax benefit during contribution years. So your contributions are after tax. So basically you get your paycheck after all your taxes. That's when you put it into that Roth IRA, Roth 401k, or Roth 403b. So that means that when you're withdrawing that money, there will be no taxes since it was already taxed when you put the money in. After 5 years, no taxes on earnings when qualified withdrawals are made at age 59 and a half for first-time home purchase, disability or death, or some qualified medical expenses. Almost the exact same as what we saw on the other side. Withdrawals after 5 years are taxed as income, but do not have that 10% IRS penalty for higher education expenses. And there is no age when you have to take the minimum required distribution. So a couple of things a little bit different here in the Roth side versus the traditional side. Always consult your financial planner before making really big changes to retirement and investment accounts. We keep this slide in here because when the pandemic hit and we saw kind of a more unstable economic climate, we were seeing people make really, really big changes to their retirement accounts, especially if they were approaching that age. So reach out to your financial planner or a professional with your retirement plan for guidance specifically. The Financial Planning Association has a list of volunteers and certified financial planners to help you navigate your investment portfolio if you have one. So highly recommend screen grabbing this slide or just taking a quick photo on your cell phone. That way you can go and find that organization. You can find that list of certified financial planners. I throw this in here that no one knows for sure when the economy will stabilize, but time is likely in your favor because you may have years and possibly even decades to gain returns when the market rises again. Oftentimes, the market goes through its swings and flows, and oftentimes it will stabilize. Just give it a reasonable period of time. So give yourself that time to recover and don't make any too rash or emotional financial decisions, especially when it comes to your retirement. So now we've kind of talked about where to stash your savings, a few different good savings options, and now we're going to briefly go through some goal setting because it is very, very important to set good, smart financial goals so you can be setting yourself up for success and focusing on your future. So why do we set these goals? Develop a roadmap and keep you on track. And setting these goals will help you with everyday financial decisions after you set goals and empower you to move closer to the future you want for yourself. So instead of worrying about, oh, should I do this new thing to my car? Should I get these new shoes or new clothing and all these new brands? It keeps yourself focused and aligns you with your future. And then your goals should tie into your top values and priorities, not other people's. You don't want to get caught up in that keeping up with the Joneses mentality of, oh, my friend got a new car, I got to go get one too. If that's your value and priority, sure. But if it's not, then refocus on what's most important to you. So when we set financial goals, we want to make them SMART goals. So we want to use each one of these individual aspects when it comes to our goals to make sure that they're going to be achievable. All right, I did get a question here. I think I'm going to wait. Let's see. So the question here is, since insured accounts have a reimbursement limit of $250,000, does that mean if something happens that resulted in insurance reimbursement, that the max anyone could get up to is $250,000, in spite of the fact that savings to the retirement account is more than $250,000? This is a great question. So basically, from my understanding, is this member is asking, if there's more than $250,000 in that account, is that money just lost? The answer would be probably yes. So since your account is insured up to $250,000, that is the most that the account is insured. I often tell members, if you are approaching that $250,000 limit, I would open, a separate account, or open an account elsewhere, whether that's your IRA, whether that's your checking or savings, just because the most that it is insured is $250,000. So there is a chance if there is more money in that account than $250,000 that it could be lost or not sent back to you because it's only insured up to $250,000. So that is a great question. As I mentioned, your regular, checking savings account is insured up to $250,000. And then the retirement account, the IRA, is insured separately up to $250,000. So I hope that answers your question. If I didn't answer it completely, feel free to send a chat in, and I'm happy to address that. But that is a great question to ask. Diving back into our SMART financial goals, S stands for specific. So you want to make sure that the outcome of your goal is very clearly defined. So a good example would be save money for an emergency fund. You know exactly what you're saving money for. A not so good example would be I should save money at some point, because at that point, you don't know what you're saving for, how much you're saving, when's your start and end date, any of that stuff. M stands for measurable. So this is, knowing how will you know if you've met your goal or if you're on track to meet it? And that is by giving your goals an exact dollar amount. So if you want to save $1,000 in 1 year, starting today, and you're paid weekly, you can calculate how much you need to save from each paycheck to meet your goal by dividing $1,000 by 52, which is just the number of weeks in a year here. If you're someone who's paid bi-weekly, like myself, you would divide by 26. If you are a true semi-monthly, you would divide by 24. And if you're a monthly paid employee, you would divide by 12 to figure out how much to save from each paycheck to reach this goal within 1 year's time. In this example, you would need to save about $19.23 from each paycheck to meet your goal, and you can track your progress over the course of the year by calculating what percentage of $1,000 you've saved. A stands for attainable. While it's good to challenge yourself and think big when it comes to your goals, you want to make sure that your goals are realistic and take into account your bigger financial picture. So in this example, you'll need to determine if you can be realistically saving about $20 from each paycheck while meeting the rest of your financial obligations. Cutting your spending is often a great way to free up extra cash, but oftentimes a lot of our bills and rent and mortgage are non-negotiable needs. Keep in mind that you can always update or revise the dollar amount and other elements of your SMART goals if you need to, so that they're more realistic and achievable. R stands for relevant. So in our ongoing short-term example, if your goal is to save $1,000 for an emergency fund within 1 year, it would align with the long-term goal to eliminate and not take on any additional credit card debt. By building emergency savings, you can avoid racking up credit card debt, so your short-term goal is relevant to your bigger value of financial security. And then lastly, T stands for time-based. So we've already established you want to achieve your emergency fund within 1 year, but decide on the exact date you want to accomplish this goal by. With that date in mind, you can develop an accurate plan of action to reach it. So in our example, it allows you to know how much money to set aside from for your emergency fund each month, by deciding how much to save from each paycheck. There's that $1,000 by 52, as I mentioned, getting you $19.23 per paycheck. A few tips for success with financial goals. Your goals do not have to be complicated. It can be something as simple as I'm going to open a free savings account and then build more goals from there. So number one, write down your goals, whether it's on paper, on an online document, on your phone. Just write them down because they're more concrete and likely to be achieved if your goals are written down somewhere. Say your goals as positive statements. I will instead of I won't statements, so that your goals are positively worded, and using strong action verbs like I will instead of I would like to. You can tell there's a difference there. Set predetermined intervals to measure your progress. That could be monthly, once every 6 months, or annually, really depending on your goal, if it's a short-term or long-term goal. Number 4, review your goals and adjust or update them as needed. Your life, work, or financial situation may change, so revisit your goals and make sure they're still achievable and aligned with your values. I also say any big life change, whether it's, a job change, maybe you have a family change, you're moving, any of these would be great times to revisit those goals. A few more tips here. Tap into your motivation by using visualization. So ask yourself, why did I set this goal in the first place? And then try and visualize how your life will be different or how you will feel by achieving these goals. Another thing I've done using visualization, because I'm definitely a visual learner, is I've even taped little sticky notes onto my debit or credit cards with, an airplane or a house or things that align with what I'm working towards. So that way, anytime I open up my wallet and I see that, it makes me think twice about that purchase. Number 6, everyone has setbacks. It's how you deal with them that matters the most. So if you get off track, adjust accordingly, but don't give up or allow a temporary setback to deter you from reaching your goals. Your goals may need to be adjusted, emergencies can happen, but continue to set and work towards your goals. Like a GPS, if you take a wrong turn, try and get back to your path as soon as possible. A few resources I want to share before we wrap up today's class and open it up for Q&A. So first one is you are more than welcome to schedule a free confidential one-on-one financial coaching. We are doing them virtually via phone and video chat, especially since the Acoma branch is under construction right now. We do have a resource directory as well to community resources, support services like 211, fraud prevention information at myzing.com/help. And then lastly, those e-learning courses. As I mentioned, we've got like 40 to 50 of those on there. They're really great interactive modules, and those are available in both English and Spanish. And I will open it up for questions. If you don't have any questions, feel free to hop off and enjoy the rest of your day since we got done a bit early. But if you do have any questions, feel free to plug them in the chat box and I will be hanging out. I just want to say thank you all for your time and thank you for coming today. I really appreciate it. And I hope everyone has a good rest of their Wednesday and stay warm because it's a snowy one out there.
I have a question here.
Yeah, absolutely. Go ahead.
Yeah, so you mentioned the laddering CD strategy.
Yes.
And I was wondering, just overall, is there like a way of showing that comparison over a lump sum, like a standard lump sum, like that you may just put into a 60-year or anyway? I was trying to think of how to calculate that, and it just was a little tricky. So I wasn't sure if you may had some thoughts on that or anything on how much more you would save by laddering or gain by laddering.
Yeah, that is a great question. I don't have a calculator like right in front of me here, but I will share a resource that I personally use, and it's called bankrate.com. So Bankrate, they've got a ton of calculators on there, whether it's for loans, early credit card payoffs, paying off your car, figuring out your payment, but they also do have certificate of deposit calculators. So it allows you to put in, let's say you're going to put in $300 for a 36-month CD, and here's the rate. It will give you the interest over the course of that CD, that term. So I think they actually have an option where they have a laddered CD calculator. So I would highly recommend checking out bankrate.com. They have some good calculators on there. I know they have a CD calculator and possibly even a laddering one. So I would check out there. If not, I can see if I can find any other resources for you.
All right. I mean, I probably could figure it out. I mean, it sounds like you just put 800 in the 60 month opposed to the strategy of everything else. So
Yeah, and then you can kind of compare, which one would lead to more return. The laddering is also just a good option in case you're a little nervous about putting that whole dollar amount into a 60-month CD, just because it'd be tied up for a longer period of time. So yeah, it's a great option to check out both.
and I wasn't sure. Could you go back to that slide just so that I could write down those rates for those different CDs?
Yeah, absolutely. Just give me one sec. I'll just tap through really quickly. And we also should have our rates available on our website. Oh, there those are. All right, I'll keep it here. And then I am going to go ahead and stop the recording.